Hey everyone, and welcome to this explainer. Whether you are a CA student currently burning the midnight oil, an aspirant gearing up for your exams, or a seasoned tax professional looking to brush up on the fundamentals, well, you are exactly in the right place. Today, we're laying down the absolute bedrock of income tax when it comes to employment. We're decoding Section 16 of the Income Tax Act. Look, if you want to compute salary income accurately, whether you're cracking an exam question or doing a client's assessment, this section right here is your foundation. It defines exactly what the taxman considers to be salary.
Okay, let's dive right into this and look at our roadmap. We're going to cover the scope of salary, core pay and benefits, timing and leave receipts, retirement and separation, statutory funds and schemes, and we'll wrap it all up with a quick revision summary.
All right, first up, the scope of salary. Now, before we look at the individual components, we really have to understand the lens through which the Income Tax Act views employment income. The absolute most vital word to remember when you read Section 16 is includes. This is an inclusive definition. It doesn't just casually say salary means your basic pay. By stating that salary includes a variety of items, the law casts a massive net. It captures direct monetary payments, sure, but it also pulls in non-cash benefits, employer contributions, and pretty much any employment-related receipt. The tax department knows very well that compensation is far, far more than just that fixed amount hitting your bank account via NEFT at the end of the month.
Moving on to Part 2, core pay and benefits.
Let's look at the most visible, everyday components of a compensation package. Right at the top, Clause A brings in wages. You see, in the eyes of the income tax law, there is literally no difference between the salary paid to a white-collar executive and the monthly wages received by a blue-collar factory employee. It's all taxed under the head of salary. Plus, Clause D specifies any fees or commission. Think of a sales executive. They might get a modest base pay, but earn a massive performance-linked commission for hitting their targets. Because that commission arises directly from the employer-employee relationship, it falls squarely under this inclusive definition.
Next up, we have Clause E, which introduces an absolute favorite for CA exams, perquisites, or as we all call them, perks. Perquisites are basically benefits or facilities provided by your employer in addition to your regular salary. And just because they might not be paid in hard cash, well, that doesn't let them escape the tax net. Real-world examples? Think of a company-provided car, rent-free accommodation, or even employer-provided club memberships. These facilities have a distinct monetary value, and Section 16 ensures that this value gets included right into your taxable salary.
Now, what's really interesting about this is how the law anticipates alternative forms of compensation. Clause F includes profits in lieu of or in addition to any salary or wages. Now, what does in lieu of actually mean? It simply means instead of. Let's say an employee's contract gets terminated and they receive a hefty lump sum compensation payment from the employer for that termination. Even though it's obviously not their regular monthly pay, it's received instead of future salary, and it arises directly from that employment relationship. So the law clearly traps it right here as salary.
Okay, Section 3, timing and leave receipts.
So let's shift gears and think about timing. Consider this conceptual question for a second. What happens if your employer is generous enough to pay you your salary for the next 3 months? Today, before it has actually accrued or become due? Does the taxman politely wait for those 3 months to pass? The answer is a resounding no. Under Clause G, any advance of salary is explicitly included in the definition. If you receive your salary for future months in advance, it triggers taxability right now, the moment you receive it. It remains salary income, and the law basically ensures that advance payments don't defer your tax liability.
And then we have Clause H. This deals with what happens when you just don't take your vacations. This clause includes any payment received by an employee in respect of any period of leave not availed of by him. In practical, everyday terms, this is leave encashment. If you've got, say, 30 days of unused leave piled up, and you receive a lump sum payment for those days, which usually happens when you resign or retire, that cash is inextricably linked to your job. Therefore, Section 16 ropes it straight into your salary.
All right, Section 4, retirement and separation.
Look, the employee life cycle eventually wraps up, but the tax implications, yeah, they definitely do not. Under Clauses B and C, Section 16 includes any annuity or pension and any gratuity. Think about a retired employee receiving a monthly pension or getting a lump sum gratuity payout as a reward for years of loyal service. Even though that person is no longer actively working or showing up to the office, these payments are deeply, fundamentally connected to their past employment.
Because the employer-employee relationship is the root cause of the cash flow, it is taxed under the head of salary.
Next up, Section 5, Statutory Funds and Schemes.
Okay, take a deep breath for this one, because we're getting into the highly technical segment dealing with government and employer-backed savings mechanisms. Clauses I and J deal with the Recognized Provident Fund, or RPF. This basically happens in 2 steps. Step 1, under Clause I, is the taxable annual accretion to the balance of an employee in an RPF. This means the employer's contributions and the interest credited to the funder in the year, but strictly to the extent to which it is chargeable to tax under the rules of Schedule VI. Step 2, under Clause J, deals with a transferred balance. If an unrecognized fund suddenly becomes recognized, the specified taxable portion of that transferred balance is included in salary. The key takeaway here? Taxable portions of your RPF buildup are treated as salary.
Now, let's compare clauses K and L, which handle specific scheme contributions. Clause K includes the contribution made by the central government or any other employer to an employee's pension scheme referred to in Section 124. Compare that with the newer Clause L. This one specifically includes the contribution made exclusively by the central government to the Agnivir Corpus Fund account of an individual enrolled in the Agnipath scheme under Section 125. In both of these cases, money's being parked away for the individual's future by the employer or the government, but the law classifies those specific contributions as a component of salary right now today.
We are almost at the finish line. Section 6, Quick Revision Summary.
So, the crucial point here is that Section 16 literally leaves no stone unturned. Let's lock all 12 of these clauses into place for your exams and practical assessments. Here's the first half of your Section 16 checklist. We've got Clause A covering basic wages, Clauses B and C pulling in your retirement benefits, annuity, pension, and gratuity. Clause D captures performance pay like fees and commission. Clause E brings in the non-cash benefits, the perquisites. And Clause F catches any compensation or profits in lieu of your standard salary.
Moving right along to the second half of our checklist, Clause G taxes your advanced salary right now. Clause H captures your leave encashment for unavailed time off. Clauses I and J handle the taxable annual accretions and transferred balances of your recognized provident fund. And finally, Clauses K and L pull in the central government or employer contributions to Section 124 pension schemes and Section 125 Agnivir Corpus funds. 12 clauses, one massive, inclusive definition.
Knowing exactly how broadly Section 16 casts this net, I want to leave you with a thought. Take a look at your own payslip or the compensation structures you're designing for your clients. Are there hidden components, perquisites, scheme contributions, leave encashments that you honestly never realized were officially classified as salary under the law? Section 16 is just the gateway. Once you recognize how incredibly wide this net is cast, the real question becomes, how do you legally optimize it? Master this inclusive definition, and you've absolutely conquered the toughest hurdle in employment taxation. Thanks so much for joining me on this explainer. Keep studying hard, and I'll catch you in the next one.